In this chapter, we are going to walk through direct participation programs, often shortened to DPPs. These are a unique investment structure that show up in the alternative investments part of the test, and they have a few features that make them stand apart from stocks and bonds. Let us start with the basics. A direct participation program is a pooled investment vehicle. What makes it special is the word pass-through. Income, gains, losses, and tax benefits flow directly to the investors, instead of getting taxed at the entity level first. Most DPPs are set up as limited partnerships, which we will break down on the next slide. Investors are called participants because they directly share in the economic results, both the upside and the downside. One thing to remember: DPPs are not traded on exchanges. There is no quick way out, which is something we will keep coming back to. And the key concept here, the one to lock in early: pass-through tax treatment, no corporate-level taxation. Now let us look at how a limited partnership is actually structured. There are two roles. First, the general partner, or GP. The GP runs the business. They make decisions, they manage operations day to day, and in exchange for that control, they take on unlimited liability. If the partnership goes south, creditors can come after the GP's personal assets. Then there is the limited partner, or LP. LPs put up capital and stay completely passive. They cannot manage the business, and in exchange for staying out of the way, their liability is limited. The most an LP can lose is what they invested. Quick example. Imagine a GP running an apartment building DPP. The LPs fund the deal, but they don't pick the tenants or sign contracts. If you see a question contrasting GP and LP liability, the answer is almost always the same: GP unlimited, LP capped at investment. Pass-through taxation is the headline benefit of a DPP. So let us slow down here. A regular corporation gets taxed twice. The company pays corporate tax on its profits, and then, when it pays a dividend, the shareholder pays tax again. That is double taxation. A DPP avoids that. The partnership itself pays no entity-level tax. Instead, all the income, gains, and losses flow directly through to the partners, who report them on their personal tax returns. The form that gets used here is the Schedule K1. This is one of those facts the test likes to check. Partners receive a K1, not a 1099. If you see 1099-DIV in the answer choices for a DPP, that is the wrong tax form. DPPs can invest in a few different categories. The two big ones to know are real estate and oil and gas. Real estate DPPs hold things like apartment buildings, offices, and shopping centers. The big tax benefit comes from depreciation deductions. Oil and gas DPPs invest in drilling and exploration. The big tax benefit there is intangible drilling costs, often called IDCs. Equipment leasing DPPs hold things like aircraft and machinery, and they generate income from leases plus depreciation. And agriculture DPPs invest in cattle, crops, or timber. These have specialized tax treatment, but show up less often on the test. If you remember just two, real estate and oil and gas, you will be in good shape. Real estate DPPs invest in income-producing property. The income comes from rent, with potential appreciation if the property gains value. But here is the real selling point: depreciation. Tax law lets the partnership deduct a portion of the property's value each year, even if the property is actually appreciating. These are called paper losses, because no real cash leaves the partnership. Those paper losses can be used to offset other passive income for the partner, which is the tax shelter angle. Subtypes include residential, commercial, and raw land. But the deeper subtypes are not what the test is checking. The depreciation idea is. Oil and gas DPPs come in 3 flavors, and they line up on a risk spectrum. At the top of the risk scale is exploratory, also known as a wildcat program. They drill where there may or may not be oil. High risk, but the highest intangible drilling cost deductions, which is the tax shelter angle. In the middle is developmental, drilling near proven reserves. Moderate risk, IDCs, plus some production income. At the bottom is income, also called producing. The wells are already pumping. Lowest risk, steady income, but very little tax shelter benefit because the drilling has already been done. There is also something called a depletion allowance, which lets investors deduct as reserves are used up. If the question pairs wildcat with high tax benefit and high risk, that is the right association. DPPs come with real risks, and the test wants you to know them. Illiquidity is the headline risk. There is no active secondary market, so if you want to get out, finding a buyer is difficult, and the price will reflect that. The holding period is long, typically 5 to 10 years or more, and reporting is limited compared to a public company. You won't see daily prices. Manager risk matters because the GP runs everything. So a weak GP means a weak DPP. And on top of all that, tax laws can change, which means the tax benefits you bought in for can shrink. Capital risk is real too. You can lose your entire investment. If the test asks for the number 1 risk associated with DPPs, illiquidity is the answer. Here is a tax rule that catches a lot of students off guard. The IRS classifies DPP income and losses as passive. That sounds harmless, but the catch is this: passive losses can only offset passive income. So if you have a loss from your DPP, you cannot use it to lower the tax on your salary, and you cannot use it against your stock dividends or bond interest. Wages are earned income. Dividends and interest are portfolio income. Neither is passive. If you have unused passive losses, they don't disappear. They carry forward to future years, where they can offset passive income later. The trap on the test usually involves an investor trying to use DPP losses against their salary. That doesn't fly. Suitability questions on DPPs almost always come down to a profile. Who is this for, and who is this not for? Suitable for someone with a long time horizon, high income, high net worth, and the ability to lock up money for years. They want the tax benefits and they understand the risks. Not suitable for someone who needs liquidity, someone conservative, or a first-time investor who hasn't built a financial cushion yet. DPPs in retirement accounts. An IRA is already tax-deferred. Putting a tax-advantaged investment inside a tax-advantaged account wastes the benefit you are paying for, and the illiquidity makes it worse. If you see a DPP recommended for an IRA on the test, that is almost always unsuitable. Let us put DPPs side by side with a corporation, because the test loves this comparison. Taxation. DPPs pass through. Corporations get taxed twice. Investor liability. Limited in both cases, since LPs are only on the hook for what they put in, and shareholders are only on the hook for what they paid for their shares. Management. A GP runs the DPP day to day, while a board and an executive team run a corporation. Liquidity. Public corporations trade on exchanges, so getting out is easy. DPPs are illiquid. And the tax form difference is a clean memorization point. Partnerships issue a K1. Corporations send a 1099-DIV. If those forms show up as answer choices, that distinction is what the question is checking. Let us close this chapter with the things you absolutely need to lock in. A DPP is a pass-through entity, almost always set up as a limited partnership. The GP runs it and carries unlimited liability. The LPs put up the money and have limited liability. Income and losses flow to the partners through a Schedule K1. The major types are real estate and oil and gas, with equipment leasing and agriculture rounding it out. The biggest risks are illiquidity and the long holding period. And the passive activity rules limit how useful those tax losses really are. They only offset passive income. Finally, never put a DPP in a retirement account on a suitability question. That is the easy giveaway.